When we talk about trading, most people fall into one of two categories. The two categories are fundamental or technical traders. Trading with fundamental analysis uses fundamental factors such as economic, financial, and other quantitative and qualitative conditions. Future prices are speculated using industry and company-specific factors such as the company's EPS or earnings per share, the revenue, and the PE ratio, which stands for price to earnings ratio. The PE ratio represents a company's valuation. Revenue is the company's earnings, and the EPS is the company's earnings relative to their share price. For example, if you were to purchase a stock because you noticed that the company's earnings have been rising faster than the share price, this strategy will be considered fundamental trading. Fundamental traders tend to hold positions much longer than technical traders. Technical traders prefer using technical analysis and measured data to predict future prices. Technical analysis is the method of trading stocks by analyzing statistics generated by the market activity, such as past prices, moving averages, volume, and technical indicators and overlays. Future prices are speculated using charts and other technical tools. For example, purchasing a stock based on the 50-day moving average crossing over the 200-day moving average is an example of technical trading. We will dive deeper into technical trading in the upcoming lectures. It's important to remember that whatever trading style you use, there is no guarantee that the stock will perform as expected. For instance, when all technical analysis signals show that the stock should go up, fundamental factors such as quarterly earnings reports being released by the company can cause the stock to perform poorly. On the flip side, if you use fundamental trading and expect the stock to go up on some good fundamental news, the stock could actually fall due to technical traders selling on technical factors. Nothing is ever guaranteed. The goal is to simply win more than you lose. Besides either being a technical or fundamental trader, you could also choose to be either a long-term or short-term trader. Long-term trading is when you purchase an asset or shares of stock with the intention to hold for a long period of time. Most often used with fundamental trading, typically long-term traders will hold for weeks, months, and sometimes even years. An example of long-term traders could be swing traders who can hold positions for weeks and even months at a time. Usually, fundamental traders care more about the underlying value of the company and not the day-to-day price action. This allows them to have confidence to hold for extended periods of time despite volatility. Short-term trading usually involves holding a position for a short amount of time. This could be anywhere from days to hours and sometimes just minutes. Short-term trading methods can include strategies such as day trading or sometimes swing trading. Typically, short-term traders use charts and other trading tools to buy and sell instead of the underlying fundamentals. I definitely consider myself a short-term, technical trader when it comes to stocks. I couldn't care less about what the company does or who the CEO is. I only use charts and other tools to make all of my stock trades. I also have some investments, so I guess I could be considered a long-term trader as well. So before we continue, let's take a look at some of the asset types that are available for you to trade. I'll see you in the next video.